You are listening to I Am Refocused Radio with your host, Shamaya Reed. This show is designed to inspire you to live your purpose and regain your focus. And now, here's your host, Shamaya Reed.
Hey, welcome to I Am Refocused Radio. We are here once again. And today, man, we're going to learn all about credit. I mean, have you met someone that has consumer debt? I mean, I'm going to raise my hand first. We all been there, done that. We've been through it, might still be going through it. But man, today we have an amazing guest. His name is Todd Christensen, and he's an author, financial educator, counselor. He also has a podcast himself, and he's a blogger, does amazing things with his website, moneyfit.org. He has counseling programs. He has debt services. So if you're trying to get money fit, this is the episode you want to check out. So, man, first and foremost, Todd, welcome to the show. How you doing, man?
I am doing great. Thank you so much for having me. I'm looking forward to our conversation today.
I appreciate it, man. I know I'm not going to be the only one that's going to learn amazing things today, especially money in these times. I mean, any time is important, but in these times, I think it's crucial to kind of get your money right. So, man, kind of give us a little backdrop. What inspired you to do what you do, man?
You know, I've always, since I was young, wanted to be a teacher, and I'll be honest, I got lucky, and I stumbled across this opportunity 20 years ago to work for a nonprofit as their education coordinator at the time, and I'd been out of school for a couple of years, and I saw this. I thought, okay, I get to teach, and I don't have to grade homework, and I don't have to deal with angry parents. You know, it just seemed ideal for me. So, and money, you know, it's funny that you see a lot of people who tend to go into professions that they may have struggled with when they were younger, and money was definitely something that I struggled with, and have really enjoyed learning more about and then sharing those lessons in my classes.
I love that because, I mean, it's something that we will deal with as long as we're on this green planet Earth. I don't think there's going to be any day unless, you know, you're like, I don't know, still in high school. Well, even at that, right. I mean, think about it. I'm going to ask you that question. When is the average age when a person actually has the opportunity to learn about money?
A lot of people think that is high school or even after high school. I like going into middle school classes because these are kids that are starting to earn money doing chores around the house or in the yard or for neighbors. And that's the ideal time. You know, it may only be $10 or $15. But early on, if they learn, if all I know is how to spend it, you know, they learn how to earn it, how to spend it, but they haven't learned how to save it or even how to be generous with it. I mean, they just think money is to earn and spend. And there are other things that we can be learning to do with our money.
Well, I think a lot of people can relate to college days. You get your credit card and you're away from home, and, you know, sometimes you can get yourself in debt, and consumer debt is a very hot topic right now. I'm sure you probably know a lot more stats than I do, but when you look at the stats, someone in your profession, what's some of the similar trends that you have been seeing lately?
There's, you know, when COVID hit and all those checks went out, all those COVID checks went out to every household, our household savings rate skyrocketed. People were using that money, instead of, there were households that used it to survive and get through. But for the most part, the vast majority used it to put into savings or to pay down debt. And we saw a huge number of, a huge spike in savings and a huge decrease in our debt levels. Those are actually coming back up to or returning to pre-COVID figures now. Savings was before COVID, 3% of our discretionary income would go to savings, that's not your total income. That is after your housing, after your food, after your transportation, and utilities, all that. 3% was not much. and it spiked to 25 to 30% early in the pandemic. And then each time a check would go out, we'd see it spike again, but it's back down. We have very short-term memories as Americans, especially when it comes to money, and we're back to living paycheck to paycheck. We've spent all of that savings, and we're seeing the default rates on everything from credit cards to car loans to mortgages return to their pre-COVID levels. So that's always a concern. We were always hoping, hey, this is a chance for us to make a long-term difference, but that long-term turned out to be maybe 3 years.
Once again, listen on Refocus Radio, talking to our special guest today, Todd Christensen, and he also have a podcast, The Money Fit Show. But before we dive into that, let's kind of go over your website, moneyfit.org, because you have some different services, depth services that I think are very crucial for our listeners. And we love call to action here on Focus Radio. So kind of give us just some different points on some of the services and how they can be very beneficial.
Yeah, we are a nonprofit because of our education charter. So we have a lot of educational programs on our MoneyFit website. It's called the Academy. You can take free classes on there at your own pace. And there's calculators on there people can use to figure out, their own budget. There's several different options for budgets because some people don't like the traditional write down everything you earn, write down everything you spend, and balance that. There's other options for you. And we have a debt management program and our credit counseling program for people who are struggling to deal with their current debts. There are housing counseling services. We are a HUD certified housing counseling service. And so anybody who's looking to buy a home, figuring out how to get into a rental, or struggling with home ownership or renting, that sort of thing. There's services for as well for that. And some of those have some fees, but they're all highly regulated and capped and quite appropriate for the services that are provided.
And someone listening right now, maybe they're managing what they are managing, currently. What words of wisdom, like black and white cutting through the noise, what's something that people should be doing starting today after they hear this episode? What's some money habits that they can practice to better position themselves in the future?
Yeah, great question. I mean, without a step today, I remember 15, 20 years ago, attending a workshop, and the guy, he was with one of the major banks. He said, now you've learned all this stuff. You spent a day and a half with me. If you don't do something by the end of today, you'll never do it. He says, you got to do something. And so if you want to make a difference with your finances, here's a couple of really easy steps. One, first of all, sign up for some sort of a blog subscription or a podcast or something where you're just going to get information coming in regularly as a reminder of, oh, that's right, I said I'm going to do something about it. Just sign up. There's so much good information out there. In fact, there's so much bad information out there. So it is kind of tough to get to cut through the noise, as you say. But the other one, go get your credit report, annualcreditreport.com. It's the only federally authorized website to get a free credit report. By law, we get it once a year, but since COVID, we've been able to get it once every week from all three of the consumer reporting agencies, or also known as credit bureaus. There's no negative effect at all on your credit for checking your own credit report. And you just want to look at it and say, okay, is this accurate? Because there's a lot of stuff on there that may not be accurate. It might have been misreported, or heaven forbid, you are a victim of identity theft. You didn't even know it. You can do that for you just go to annualcreditreport.com, but you can also go, a lot of people don't think about it. You can go to Check Systems, CHEX. It's kind of like, it's spelled like the breakfast cereal. Check Systems, and that's another consumer reporting agency. It's more related to our banking activity, but we also want to look at that, make sure that it's clean and accurate. Those are some really easy things to do right now. It's free. and takes maybe 10 minutes, 15 minutes if you, or 20 if you're going to do all three consumer reporting agency reports all at the same day.
And when people are understanding their credit reports and their scoring system, um, what is a healthy credit score, and why?
Yeah, that's a good question. Let me preface this because there's so much what I just say bad information about credit scores, and it's perpetuated by even lenders. When you go to see a lender, they'll talk to you about the 3 C's or the 4 C's or some of them in the 5 C's. And one of those C's, they say, if you want to be good credit, one of the C's is character. And we tend to tie our credit score to our personal reputation. And I think that does everybody a disservice. It has nothing to do with whether you're a good person, bad person. But that's the way I hear it. I hear people coming into our classes or into my counseling sessions say, I just, their heads down, eyes are on the floor. I got a terrible credit score. I'm a bad person. And it's really not. Credit score is just a predictive score. It's trying to tell the lender, this is the likelihood that this person is going to pay in the future, their debts in the future. What doesn't matter their efforts. It's because of maybe they have overwhelming medical debts or are unemployed, just became unemployed. We don't know. But that's what the score is for. Okay, so with that preface, scores do range from way down in 300. And I'll be honest, I've heard of scores in the 300, but I've never seen a score in the 300s, all the way up to 850. And again, I've heard of people having an 850, but about 10% of the population is above 800. Honestly, anything above a 750 or so is going to get you the exact same benefits as somebody who's got that very rare person who gets an 850. That's only bragging rights, and I think that's kind of a misguided bragging rights. If you just work on making your payments on time every month and paying down your debts, you're going to have excellent credit with a couple of accounts. But it just depends on what you're using credit for. If you are looking at buying a home in the next year or so, and your score's down in the 500s, you can do some things to rebuild that credit up into the mid 600s or even upper 600s so that you can qualify for the best interest rates that, for example, an FHA loan has to offer. They'll lend all the way down into the 500 score range. But if your goal is to get the best interest rates possible, sometimes that might just be a 690. You don't have to worry about a 750. But if you're like getting ready to buy a car, and I'm not a huge fan of car loans, but I know it's kind of the way of the world anymore. But car loan, if you want the best interest rate, it's typically going to be that 740, 750, 760 on up. It's just a matter of what you're going to do with it. If you're looking at getting an apartment, some property managers will say, okay, you have to have a 680 or 650 or a 715. It just depends on the agency or the organization. So it's look at what you want to do with your credit, and then find out, well, what's my goal? Call the apartment complex that you want to move into and say, what's your minimum credit rating, credit score? And then make a plan and work toward that. You can build and rebuild credit in a year or less to something pretty decent. In most cases, I mean, there are some times where you're dealing with major bankruptcy, lots of collections, things that might take a little longer to clean up and to get back on track. But most people that I talk to, that when they come in my office, they think their credit score is much worse than it actually is. We just have this tendency as humans to expect the worst. But it's talk to somebody. We offer those free credit score analyses right now, and somebody call. We can do this by phone or on the Zoom, and just give them some ideas on what's working, what doesn't. Typically, educate them on how to rebuild and their score and what to do with it.
We're talking to Todd Christensen and all about his website, moneyfit.org. And when it comes to credit, and scores, all that good stuff. Someone who's interested or has heard of consolidation, but they don't know what that is or what that actually, works, how that works. What are some things that people should know about it before they think about starting that process?
Right. It's a really generic term. It's a great question because it needs clarification. Debt consolidation means a lot of things to a lot of different people. We think, okay, I'm going to consolidate my debt and then I only have one payment. And there's a lot of different options to get to that. Mm-hmm. You can do a balance transfer on a credit card, for example. That's taking all your debts and having a new credit card, or maybe even your current credit card, pay off all those debts, and then all your debts now are on the one account. Benefits, one monthly payment. And sometimes that might be at a lower interest rate than the other cards. Drawbacks, maybe not. Maybe the new interest rate is not as high as they promised, or as high as you expected, or low as you expected, excuse me. Or what a real problem is that within a year or two, the majority of people who do that not only have that new debt in the one account, but then they'll start using all those old accounts and build that debt right back up to what it was previously, and they've effectively doubled their debt in a year to two. So that's a balance transfer. The same problem can be seen with debt consolidation loans. This is a personal loan where you ask a lender, bank, credit union, one of those corner or the strip mall lenders, to give you a new loan that you can use to pay off all your debts, and then you only have that one payment. Typically, that interest rate is going to be in the upper single digits, 8, 9, 10, maybe 10 to 12, 15%, unless you go with one of those finance companies, like I say, in the strip mall. And I've seen those in the 25, 30% range, and they're really hard to get out of. So just be careful, be aware. Go with check with your current bank or your current credit union to see what their options are. And then you have the other options, like a debt management program through a nonprofit credit counseling agency like ours, where it's not a new loan. You're not transferring any debt from one account to another. You retain the exact same debts, exact same creditors, but the nonprofit credit counseling agency works with those creditors and to lower your interest rates, quite often down to 2% or 5 or 8%. So in the single digits. And the account's closed, so you don't use them anymore. You're not tempted to double your debt, as I mentioned earlier. And you're out of debt in 5 years or less. No direct FICO influence on your score. FICO's has straight up online saying this. We don't consider this. But your account's closed, which may or may not have an effect on your score, depending on what your current situation is. The point is, you're getting out of debt, and you are paying minimal fees, and it's usually much less monthly payment than what you're dealing with now. And in the end, you have 3 to 5 years. There's no prepayment penalty. You can always pay it off early, but 3 to 5 years of on-time payments and zero balances on all those debts. So downside is the monthly fees, but as I mentioned, it's usually, even with the fees, it's less than what most creditors or consumers are dealing with now. Those are kind of the main debt consolidation options. Some people consider a debt settlement as a debt consolidation, but you got to be careful because that's not really consolidating your debts. These debt settlement companies would say, don't send us any more. Don't send any more money to your creditors. Send it to us instead. And after a year, we'll take some of that money and try and get you out of what you owe. A lot of risk there, besides the negative impact on your score, but there's a potential of being sued and having your wages garnished long before they ever get to the point of settling. So settlement has its there's a place for it, but it's not typically ideal for most people who are just dealing with a lot of credit card debt and could benefit instead from just consolidation and lower monthly payments or lower interest rates.
And people's relationship with money, it always differs depending on the person, their lifestyle, and what their goals are in life. Someone listening right now and You're like, okay, I can really dive into this like basics of like fixing what is broken right now. Because if it's not broken, then you're good. But if
Yeah,
like
right.
most people, at least I would say United States, who are experiencing managing their debt and getting better controlling, is it good for people to think on the terms of basically like stop the bleeding, find ways to avoid having to use a credit card?
It's a good question. So there's different options, Shemai. You can look at, you can approach it from the side that, okay, yeah, there's some consumer bleeding going on here. I know I'm spending way more than I'm bringing in. My credit card debts balances are going up, or my payments that I barely can afford are not making any impact on them. There is the spending aspect, and unfortunately, that tends to be an issue in the vast majority of households. And we dismiss it as, hey, I am spending every penny I earn is going to bills, as if to say that every bill is a need. But if you or any of your listeners have ever lived in a third world country, you'll know that most of the things we spend our money on are wants, and that includes that $500, $600, $700 monthly payment on a vehicle. We tend to just dismiss it and say, no, I need a vehicle to get to work. Well, that's fine. You need transportation, but does it need to be a brand new, top of the line, everything included type of a vehicle? But it's so easy to start justifying that. And the same thing with houses. We talk about how expensive houses are, and I've gone back now 80 years where I can find information on home prices and the sizes of home and things. And based on what I found, the percentage of our income going toward housing is still very similar to what it was 80 years ago. On a per square foot basis. Gotta put that out there. Our homes have more than doubled compared to the size that they were 80, 60, 70, 80 years ago. So it's not that our housing is more expensive, it's that our houses have become much larger, double what they used to be. And that's just expectation. We have to have more room because look at all the stuff we have to put in there. Every child needs his own room, and every child needs his own game room, and every home needs the 3 different rooms beyond the bedrooms. It's just, and then we say, housing is way too unaffordable. No, it's we all enjoy room. And I'm not saying we shouldn't, but we need to understand we can't completely complain about housing prices when we are unwilling to live in what our parents or grandparents lived in. Because we talk about, our parents had a better lifestyle than we do. I think 60, 70% of Americans believe that they're not going to live as well as their parents. If you look at the homes that they grew up in, wow, we had a huge head start. So spending is one issue, and the expectations that come with our lifestyle as Americans and generally in the West. But there are other issues, whether it's the economy and unemployment and finding a better income, or it's medical debt there's no fixing that in any easy way of fixing our medical system and our health insurance, where it's common for a household to have to spend $1,000 or more just every month just to say they have insurance. Doesn't matter if you use it or not. That's your premium. Outside of, if you don't have it through your employer, it gets pretty tough. So healthcare and expenses. That's a lot of news agencies will say, the majority of bankruptcies are caused by medical debt. The majority of bankruptcies have people who go through bankruptcy have medical debt doesn't mean that that's what caused it. The people we talk to say it was unemployment, lack of savings, overspending, and then medical debt. It's a pretty distant third.
And those are some great points for us to really think about. And someone listening to this also, I mean, starting on day zero, if it's your first time getting serious about maybe just cutting your spending or just, starting to really focus on getting things paid off. I mean, basics. I think it's probably safe to say, look at your lifestyle, Can you look at different areas where you can either minimize or just completely stop spending there, whether it's eating out all the time or if it's just, I got to get new shoes or, new outfits or whatever it could be that's contributing to the problem or just your opposite of your goal. It's got a good place for people to kind of say, okay, we're going to start this today, not
Great
tomorrow.
Point. Yeah, we don't prioritize. We're not, you've heard of mindful eating at the table. Make sure that you're just eating being aware of what you're eating. We need to do mindful spending because we spend on just whatever comes through the door or whatever we see online and just have to prioritize. Is this really what I want to be spending my limited income on? Yeah. Set your goals, spend on priorities.
Yeah, and can I live without this? And the question is, if the answer is yes, then okay, cross that out.
Yeah, great point. Easy question to ask.
Because with I was real quick, when you look at like my generation, I mean, subscriptions are crazy. You literally can look on your iPhone and look at all your subscriptions, and it's like, okay, I don't need Netflix. I don't need all this stuff. I can, even, do away with it for a season until you can fit in your budget again. But I think that's also another thing too, like all the activities that you do for, watching TV or movies. Maybe it's good to cut back a little and then you can go back once it fits your lifestyle.
Yeah. Those subscription, we are subscribing ourselves into the poorhouse. I mean, there's just nothing left at the end of the day. Everything is a subscription. I mean, you can have food delivered on a subscription basis almost. So yeah, take a look at that. There's even apps out there that will help you identify subscriptions that you're not using. Try it. Some of them are free. Some of them are paid.
We're talking.
Some of them are on subscription, I'm sure.
Yeah, and that's my point. Like, it's so easy in today's time where by convenience that you can subscribe to something, and that's cool. But sometimes it's like you almost have to go old school, like your parents when they were growing up. I don't need to do all that. There's other ways to enjoy life than having another $9.99 or $12.99 a month. There's other ways to doing things. But man, once again, people can learn a lot more about what you do at moneyfit.org. You also have a podcast that people can check out, The Money Fit Show. Real quick, before I let you go, what's the call to action you want for our listeners and some of the things they can learn on your podcast?
Check out the podcast because you'll listen from what I do is I ask if you're lacking motivation. That's what we are trying to put out there. We talk to guests who have gone through from some pretty difficult financial situations and how they got through them. So if you think you're having it tough, listen to some of these stories and how people got through them. And it's not all luck. A lot of people say, oh, I'm just, rich people are lucky or people who are financially stable are lucky. It's not just luck. It's perseverance and it's hard work. And it's just, we have to prioritize it. But yeah, that's what the Money Fit Show is about, is helping others find that inner money beast to take over and get them to what they want to do. So money's just a tool. It's not our goal. It's just to help you get what you want out of life.
Well said. Once again, man, I want to say thanks to Todd Christensen for taking time talking to us today. Visit his website. His website is moneyfit.org. And also he has a podcast that you can go subscribe and rate for him real quick. It's The Money Fit Show. I wanted to rhyme. That's what the problem was. The Money Fit Show. And thanks, man. Thanks again for taking time talking to us today.
It's been my pleasure. Thank you for the chance to do it.